let's discuss how options market making works in general. So you are placing offers and bids, and you are being paid the offer, and you pay the bid for the same thing, and you can turn over inventory. You consistently make money. Problem is that if the direction of the market is correlated with your trades, so essentially when customers have some information that you don't have, and they anticipate price increase, and they buy from you, and you become short as the market price is increasing. Even more so, even the customers don't have proprietary information, but they can move the market with their order flow. Like customers can be buying for hours or days, and you provide them liquidity, and they keep pushing the market against you. That's your risk. So the market making game is a trade-off between the spread you collect versus the adverse selection or toxicity that you experience. And in general, you want to turn over your inventory faster than the market moves. In options market making context, what you want to figure out is what the fair volatility curve is, because that's how you set prices in volatility space. And you want to kind of separate trading different factors. So when you get an option fill, you get some delta exposure and some vega exposure. And usually hedging delta is fairly easy. And then you have your volatility inventory and how fast you can turn it over relatively to volatility moves. But in a nutshell, what you're really trying to do is to figure out what the other market makers think volatility is worth. That's why you imply volatility curve. And you want to buy below that level and sell above that level, and just turn over your inventory over and over. That's kind of the bread and butter of a market maker. If you are quoting, then you submit bid and ask orders, or bid and ask quotes usually, depending on the exchange. And the other strategy would be if a customer places an order in the middle of spread. Suppose the spread is wide and a customer is placing an order in the middle, but they can be willing to buy above fair value but below ask. And in that case, you can figure out that this is still a profitable trade to leave that offer. And the third strategy is when underlier moves, the option values change, but the other market makers' quotes and the customer orders. So these are the three bread and butter trades of high frequency trading. So you quote, you react to incoming customers' orders in the middle of spread, and you take stale quotes and orders on underlier move. But in a nutshell, you want to be turning over the inventory faster than the market is moving in that risk factor in which you are providing liquidity. Give us a call if you want to hear more. Happy trading.